The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And unlike the other day, or unlike yesterday, I am joined by the Brain Trust himself, Mr. Chase Taylor. He's back in the saddle, feeling a little better, not fully up to snuff.
I'm not above the weather, but I'm not as under the weather as I was.
You're in the weather.
There you go.
How about that? All right. Amongst the clouds, where you belong, quite frankly. So another kind of, saucy day. It's kind of odd. I will continue to say this. I'm not trying to put salt in the wound to anybody that's not having a good year. Continue to say this is another very boring, unexotic day of outperformance for us. Nice little gain on the day, about 40 basis points. Market, on the other hand, was kind of a different story. Why don't you give us a rundown of the indexes?
Yeah, S&P closed down 2.24. The Q's down 3. Small caps down about 1%. Equal weight 1.28. Mag 7 just under 4. Rest of world equities, so non-U.S. down 0.55. So again, pretty big outperformance for non-U.S. global equities. Oil had a nice little pop higher, up to 0.25. Secretary Bessent said essentially we would take Iranian oil exports to zero if we had to, and they are sanctioning a second refinery in China. So market appreciated that. I would say the biggest thing from the day, gold up 3.5%, silver up 1.4%, another good day for copper up 1.18%. Maybe a little notable today, Bitcoin up 1%. Second most notable thing today, the dollar way back down, closing at 99.32, down 0.77. So that's the worst daily close we've had yet, after getting a decent little pop here lately. 2-year yields down 7-8 basis points, the 10-year down about 5-6. I think the biggest story for the week has been, after a scary week for yields last week, yields have been fine. They've come right back down. Something I mentioned, I think last week, we kind of had to pin the narrative on the price action last week where everyone freaked out. At this point, it looks like that was just deleveraging and we all freaked out over nothing.
Yeah. Well, we've been known to do that.
Yeah.
What do you see? So I'll say once again, you came into the day fairly sanguine, and there was nothing crazy overnight. What was, I was in a meeting when markets started getting nasty. What was that turning point? It was while Powell was talking, wasn't it?
Yep. So we started kind of negative because last night we had the new kind of export restriction on NVIDIA and other chip manufacturers. So you came in with, down to begin with. To me, I don't know why Powell's commentary moved the market, because to me, he didn't really say anything new. He kind of stayed on brand for everything he's been saying for the last 2-3 months. But I think you had Waller this week kind of come out and say, look, if it's a 50-50 ball between employment and inflation, we'll go have the labor markets back and let inflation run hot. Whereas Powell today kind of made it sound the other way. Like, hey, it's 50-50 ball. We can't let inflation get out of control. Kind of. I said, truly, that was between the lines. It's not like he said that. I think that it was as simple as the market freaked out about that. The market didn't get any signaling that any rate cuts are on the table anytime soon. Still using the word patient, et cetera. So I think the market just wants its rate cuts and it wants them now. But going back to the fact that the long bond's doing well, I think that's one of the reasons is I think if you came out and said, yeah, we're probably cutting next month, I think the back end would have been up 10 basis points, So what's good for stocks is not what's good for bonds at the moment, which is somewhat interesting.
I wonder if they have any internal targets, because you and I were talking about this right before we came on. And I do think that you're in this perverse place right now where not cutting from what I can see right now, right? Just kind of trying to read through the smoke and the opacity of it all. But it's starting to look like to me like the quickest way to get the long end down is not by cutting.
Exactly. I think if you actually wanted to really curb the long end, you'd have to raise rates, which obviously they're not going to do, and no one's trying to listen to anyone talk about that right now. But I think that's what you would actually have to do if you wanted to do that, or obviously cut spending. But
I'm nowhere close to an expert in monetary policy, especially as it pertains to like how you enact it, right? Like I'm not saying that I should be on the Fed making these decisions, but part of me thinks if somebody handed that power to me right now, my inclination is to say, listen, I didn't say you couldn't cut, but what I think you need to see before you cut is the long end going down drastically because people have recession fears. I think so. If you got like the long bond, let's say down to like 3.5, right, because of legit recession fears, then I think that you could cut without.
Right. Yeah, totally agree. The sequencing part of that, I think, is on point.
But if you cut right here, I think, and what's funny is that if you look back to other. I think it was, I want to say it was every round of QE that's gotten announced, I believe saw the long bond go up initially.
Yeah, because it has always worked sort of counter to the way you'd think it should.
Right.
Yields go up during QE.
Right.
And they tend to go down after. Yeah.
And that very much feels like where it is right now, especially with the Liz Truss experience you had in England. You know what I mean? Like, not that what happens in England has to get mirrored here, but when markets have seen that once before, I think that, like you said, I think the knee-jerk reaction, if you cut right here, would be to sell off the long bond.
Right. I think there's so much you can get away with fiscally, but you do reach a point where you stop being able to easily get away with things fiscally without the bond market letting you know it's not okay, especially in this environment where just global savings, global capital isn't as, big and growing as fast as it has been for the last 20, 30 years, where just Asian savings were just through the roof. Just the pool of global capital is smaller. And now we're not the only ones trying to sell a bunch of bonds. Like now that most of the rest of the world's doing a bunch of fiscal, they got to sell bonds too. Yep. So all that is, like another towel soaking up a spill of liquidity. So trying to sell your bonds, 6 months from now is not the same as it was 6 months ago or 6 years ago. So you're to the point where like people are going to look at what you're doing fiscally with a magnifying glass they didn't have in recent years. So they just have to be more careful.
Well, yeah. And it's funny. Again, we've been talking about it so much about it's a different game now and the game has changed and all that kind of stuff, but you're getting new reminders of it every single day. Meaning, guys, this is what a market looks like when it's not the only game in town, right? This non-competitive game all of a sudden has gotten competitive. And there's other places to put cash. And I think once, and you and I have long thought this, and we're not the only ones that did it, but the end of U.S. supremacy, and when I say supremacy, I don't mean overall.
Asset
but like
price.
Yeah.
Exceptionalism.
That we've seen over the last 15 years. We didn't know what would trigger it, but just like it seemingly wouldn't stop, it would end one day, right? Just flip. I think we've seen it end. And I think people will be like, oh, well, yeah, looking at our markets. No. I don't think the story is just being told in our markets. Look at our markets and then go look at markets around the world today. It was a decent day around the world, 40, 50, 60 bips up for most markets, right? U.S. is getting pounded for 2.2, right? It's capital flight is what it looks like to me. I mean, that's just, and it had to happen at some point. I continue to watch so many U.S. investors trying to pick a bottom in these things. I just don't get it, man. Then you turn your eyes, abroad and you're sitting there going, well, why wouldn't you buy that? We were having and we don't own this, but we were just, if you're a tech bro and you're all into that stuff, go look at a Mercado Libre and compare it to some of the stuff that there's alternatives all over the place, right? For whatever you're invested in. But right now you're still paying this premium in the United States. It just doesn't make any sense.
Exactly. Everyone's going to keep fighting the last war for probably years before they throw in that towel. And speaking of just U.S. equities, I saw two charts that I wanted to mention today. One, it basically shows the U.S. equity market performance against the 200-day. So, so you can see on the chart whenever it flushes below the 200-day. And then you can see the positioning of asset managers and levered players. So essentially professionally managed money. And obviously we're way below the 200-day for the first time in a while. And you look back at this chart, and throughout history, every time that happens, so the positioning goes down from professional investors. This time it's barely gone down. So you have this giant washout in actual stock prices, and no real people are selling. We know retail's doing quite the opposite. If you look at how many people are buying levered ETFs, that has actually shot up. So people are not just buying the dip, they're buying it hard in retail. So you kind of had this realization, like, yes, the machines are selling. Like vol control has peaked, almost as much as it's going to. CTAs went from long to short. Like, if it's a machine, it's sold. If it's a human, it most likely hasn't sold or has bought, or like. So now, if they fill out a sentiment survey, they're saying, "Oh yeah, then the market's terrible. We're bearish," and it's like, okay, but what have you sold? Not much. I think that's super telling that you clearly have. I mean, we've talked about this before, how people are going to have been trained to not only buy the dip, but just not sell, don't panic, because it's going to come right back. And then you finally have one where it doesn't come right back, and it's the first time where people didn't actually get out of those positions.
Well, you're sort of on it. You and I were talking about this too. So I think it's really interesting, and it's probably going to come as a surprise. It did to me, even though we've been talking about it, and we've been saying that. I think we both agreed that we felt the odds lean toward this outcome that I'm about ready to talk to you about. Like we both said, look, we don't see the impetus for like the ground opening up and swallowing the U.S. markets, and it's going to be devastation. But we think they're going to see downward bias. We don't think you've reached, the bottom of that yet. But more importantly, we've said multiple times, we think it could be a scenario where you get 5 years down the road and everybody looks back and goes, holy smokes, I'm down 30%. Okay, really interesting. And I was looking at something today. Do you realize that we are only about, I was wrong. We're only about 2% away from trading at the exact same levels we were at in November 21, which would be 4 years flat.
Yeah.
Right? There we are.
Nothing to me makes more sense than a sustained period of close to flat or within 20% of flat on either side, while you look at the rest of the world, which has been down to flat for 10, 20 years, and all of a sudden it's like moving.
Yeah.
Like I told you earlier today, like
we're not flat over the last 4 years.
A decade where the U.S. market's going up 2 to 4 a year.
Yeah.
And the rest of the world is going up 6 to 8.
Yeah.
Years where it's way more, way less, obviously. But I wouldn't even be shocked if the U.S. was, up 10% for a decade, while the rest of the world was, up 150% over the decade, that kind of stuff.
Well, and you've got precedent for it, right?
Oh, yeah.
So like the last time you had a market that was, and again, there's a lot of differences. It's not a perfect comp, but the last time you had a market that was anywhere close to this kind of euphoria and price, right, was 98, 99. You went sideways for effectively 13 years after that. Now, I think you can make an argument on a lot of different levels that many parts of this market were crazier than then. There are parts that aren't. But to imagine that playing out somewhat similarly, if not exact, it makes a whole lot of sense. And especially on a fundamental level, right? You look at the valuations here and you're like, okay, if we are back to truly grading stocks and companies by their financial wherewithal, that's what should happen. Right? I mean, yeah, sure. Like we've said, yeah, I'm still a believer that U.S. markets deserve a premium, not 4X.
Yeah.
Right. Not 5X. That's non-economical. That doesn't make any sense. Right. What else you see today? What else caught your mind? I thought the weakness in NVIDIA was interesting. The reason I say that is when you see a market coming after even the highest quality favorite names, when you and I,
granted, they had very specific news that knocked them.
Yeah. Yeah. But again, this is goes to our story, right? This is why you need to be careful when you own very expensive assets, because even the littlest disruption can tip them over. Now, I think NVIDIA is at a really interesting spot here. That $100 level is it appears very largely psychological, obviously a big round number like that. But, you know, the bull case for NVIDIA on a lot of different levels is getting challenged on a lot of different angles.
No doubt.
And when you look at retail positioning, Chase, you still have not seen people meaningfully readjusting their positioning.
No, not at all. And speaking of that, like, if you think about what we're talking about I mean, to me, like the real sign that this is, you know, that this new trend we're talking about will actually be growing a beard, you know, putting some age on it, will be when like regular people, you know, have their 401k, you know, 70% ex-US and like a sliver of US,
Yep.
you know, go back to the early 80s where like
70% ex-US, 20% gold, and 10% cash.
It's stuff like that where, I mean, no one's even thought about doing that yet, right?
No.
In a way to kind of view this is,
Well, I wouldn't say no one.
right.
We have.
And my wife's 401k is pretty overseas. So, and one of the ways that I view this is like a way to keep up with it and like track the trend is the options that are even available for that. And they're terrible for if you want to get ex-US exposure and something like a 401k, it's pretty bad. And then we've talked about before, like the illiquidity in some of these country ETFs or, you know, value ETFs for the rest of the world. There's no money in them still. They're still difficult to get in and out of with any meaningful size. Whenever I can just slap in a market order on some of these country ETFs or whatever, that's when I'll know like, oh, people are paying attention to this. It is growing in its stature.
I was doing an interview before I got on here, and I was going off on that I think the most frustrating part of this, and I know you share this sentiment. You know, I think people have this, and it's fairly earned in most cases, but people have this, or at least my perception is that people have a perception that if you manage money, you're like this heartless, cold, calculated, you know, all that kind of stuff. I know a lot of times, and I'm speaking for both of us because I know you're like this too, but I know a lot of times there's things that we're saying on this show or things that we're warning about that we know full well a lot of the people that we're saying it to are never going to ask us to manage their money. But it's like you don't want to see anybody getting blown up. That doesn't make my life better, right? You don't want to see anybody getting hit. It doesn't benefit you, you know? And I think one of the most frustrating things to me is, you know, we said this a while ago too, but nobody rings a bell at the top. They sort of did.
On this one, if you knew how these things work, they did.
Yeah. It was very, very obvious. And here's the killer. Here's the catch. It still is. You made a really good point. This is not a late innings play right now. Now, if you were looking to get into gold or gold miners, I would tell you to leg in. Like it's gone straight up. Give it some time, right? And if it pulls back at all, you'll probably see a sharp pullback on the miners. They haven't been doing that recently, but you probably will. You'll get a chance. But on the rest of this stuff, you're still really early innings on this.
Yeah.
And great company. Like I was saying, you don't even have to. You don't have to go buy Panamanian airliners, right? You can go buy a tech company, Mercado Libre, growing at 40% a year, trading at 55 times earnings and 6 times sales, right? Makes sense. Flip around and look at a Microsoft trading at 14 times sales. Right? Great company, but the gap doesn't make any sense. There's plenty of stuff out there. And what I'm hearing from people is they're hesitant to sell it because they should sell it. Meaning they're hesitant to sell it because it's worked so well. And you go, okay, so it did its job.
And that's how you get cycled.
That's how you get cycled, right? And you gotta, I like that term, cycled. I haven't heard that one before. But that the most frustrating part about it is you're looking at them going, it's not anywhere close to too late. The valuations out there are still compelling. And this isn't, again, it's not a skies falling thing. It's like, hey, guys, you're sitting there right now, like picking scraps out of this field that's just, you know, burnt brown and just, meanwhile, there's this meadow over there. The stuff's knee high. Right? Like there's just really easy low-hanging fruit.
Land of milk and honey.
Yeah. And it's just, you know, it's frustrating because you're looking at people going, hey, you don't have to walk into this buzzsaw, man.
And to kind of further the point on, say, you know, Mag 7, high-priced tech companies or whatever in the U.S., there's something that there's still a big shot that can be fired at them if the trade war were to progress in an unproductive way. Like, it's easy for us to get caught up in our trade deficit for goods while we forget that we have a trade surplus in services, which the tech companies don't make. They make more services than they do stuff, right?
Yeah.
So if another country gets mad enough, we'll call it Europe, call it China, whatever. I especially think of Europe in this case, where it's like, yeah, like, yes, we run this big goods deficit with you guys, but we also buy tons of your services. Like, why are we not focusing on that? If it gets to that point where they're like, you know what, forget it. Like, you guys will push back on our stuff. We'll push back on your services. That's where all of a sudden a U.S. services company that is trading at 14 times sales all of a sudden has a massive problem as their sales. And remember, half of their sales overseas. Like, all of a sudden that services trade surplus that we run becomes a problem.
It's actually like 62%.
Right. And that's something that gets lost in this. And, you know, maybe you would think the Burlingame would let some folks in the White House know, like, hey, don't forget about the surplus we have.
Well, the other side of that is, this is an extra wrinkle in that whole scenario just lined out. The companies that would be the most impacted by that are already on the radar of many of these other countries, and I know specifically the EU for non-competitive trade. Like, right. So they're already in the crosshairs, right? Meaning that I think that
they've done the signaling that they're looking.
Yeah, right. And furthermore, I don't blame them. Like, when
how else are you going
to when you look at the
Chevys, you don't buy them anyway.
Well, and I even think more about the tech companies like you were bringing up, right? The tech companies' businesses are unapologetically monopolistic. Let's face it, right? If I was running a company, or if I was running a country somewhere else in the world, I would sit there. My attitude would be, I'll let your tech companies in, but here's the cost. And why would I do that? Because I'm not going to let you monopolize my citizenry same way you've done your own, right? And also, I also want to leave a hole open for our citizens to create a competitor to your tech monopoly,
for sure,
right? And that's the stuff
that's where, like,
the tech trade has changed, man, and enough people aren't waking up to it.
It's easy to see from our perspective, like, hey, we have been kind of like disadvantaged on goods.
Yeah,
we have lost there, and we deserve to be able to push back on people. But you could equally argue from, you know, the European perspective. Sure, we let you guys do it to us in services. So, like, if we want to do this, then we'll push back on there, because that's hurt us, and it obviously has. Not having tech forward economy the way we do. I mean, that's it's not helpful in 2025.
No.
So you could argue it's just as important to their national security that they get better at tech as it is for us. So we get better at making some real stuff.
What do you think about? I was asked recently about some of the rollouts in the tech or in the tariffs. Again, on that last interview, I was talking about it too. And my take on it, you and I haven't had a chance to discuss this today, so listeners are getting it right out of the gates. My comments on it were, in my opinion, I kind of think the way the tariffs should have been rolled out to begin with is more like they're happening right now.
Yeah.
Right. So I don't know if that will impede the process going forward. I don't know but to me, the way that they're handling the tariff situation makes more sense to me than it did. You know, you and I were talking about something. The biggest target in this tariff war is clearly China, and you see it reflected in the tariffs, right? Well, the one thing now again, I'll leave some room here for some disagreement with the administration, because, you know, like you and I were talking, I know that they know things I'm not privy to. And if I knew those things, maybe my opinion would change slightly. But if I'm looking at this whole tariff scenario, I think that there are many other countries that we need to do some things with. I think there are many other countries that are running some unfair tariff policies on us that we need to deal with. But I would have liked to seen us address all of those behind closed doors, right? Basically build a coalition, right? Get those things dialed in so there's no gaps, then approach China at that point. That would have been my thought. What are your thoughts on that?
Yeah, I mean, I tend to agree. First and foremost, to me, you start small with a schedule that shows, like, if we don't get a new deal with you, then it goes up to this, then this. It just keeps moving itself higher,
like a shot clock
on very specific goods, not everything. you start from a point of like, we will negotiate in good faith. We understand that yes, things have stretched really far for goods for us, but we understand that, hey, there's probably stuff that isn't working for you either. It's just like a marital counseling. If one person goes in just angry and the other person goes in constructive, it's not going to work, right?
Yeah.
Same. I would say it's probably the same for trade, and very complex negotiations for trade.
I know, but that's also here's the tough part about that. That's also under the assumption that China is an honest actor and is a 50-50 part of that marriage. I don't think that even they see themselves that way.
Even if not, like 200, 100-200% tariff, like embargoing their trade is not gonna get it done. And I know everyone thinks they absolutely have to cave and come to us. Again, we're 14% of their exports. They can survive. I would argue better than we can without their stuff. But so to me, same thing. Like, I would just start the same place with China. Like, we start small. It's going to ramp. Here's what we want. Like, in bullet points. Here are the things that we want specifically to change, because both China and now Europe have both come out with the same thing and said, look, we are not being told what they want. There's no specifics. It's just like, trade deficit down. Like, cool. Like, let's talk about how and where and why, and like let's talk about it. So have everything specifically laid out, like a true plan. The timelines, how much the tariffs will go up. Again, the tariffs not on everything, not like a billy club, but like a more of a, like a tourniquet that applies the pressure slowly. That lets businesses plan a little more effectively. But I agree, like, obviously backing off doing the 90 days is better than putting them on and trying to negotiate. But 90 days is not enough time to do trade deals with that many countries. 90 days is not enough probably to do a trade deal with one country, especially this many, unless you do micro trade deals where you get 2 concessions from a country and you move on to the next one, like speed dating or something, which, hey, maybe that's what we do, and that's better than nothing. But I don't think that's the grand restructuring that it seems like they want to do for global trade. Okay,
let me push back a little bit with what you said about China and us, like thinking that they've got the advantage. Something very interesting that has caught my ear coming out of the media, especially the financial media lately. I was listening to an interview the other day, and I think it was Tracy Alloway from Odd Lots, and she was talking about this whole China dynamic, and they were talking about how you can't just engender a manufacturing base out of overnight. And I was like, okay. And then they were like, but China can just make up with us with internal consumption. And I just sat there and I went, okay.
Obviously not in full.
Right. First of all, I find that hilarious that you think that there are no constraints to developing more domestic consumption, right? Like, you see that as no problem for China, and yet you don't think I think it probably takes longer to build the consumption base than it would for us to build a manufacturing base. Both things cannot get done overnight, right? There's legs there. But I think we can build manufacturing faster than they can develop the consumption base internally to replace us. And I've heard that argument now thrown out there. Now, that doesn't mean that we have all the leverage. I'm not saying that. Okay. What I'm saying is there are so many stupid takes out there that I don't even know what to target, right? Like, meaning neither party involved in this, us or China, gets out of this painless. Nobody does. It's not good for anybody. And both sides have constraints. Who's got the advantage right now? I tend to think we've got an advantage. You tend to think the cards are more on China's side. I think it hurts both.
No, 100%. So that's the main point, is nobody wins.
Yeah.
I see a lot of people that want to reduce this to the binary, who like winner and loser. Like, no, nobody wins in a trade war.
No, that's not going to get.
That's the one thing history teaches us, is nobody wins in a trade war.
No. Now, does that mean it's a war we shouldn't have?
Yeah, I mean, that's obviously up for debate.
Yeah.
But to go back to the consumption thing, though, I definitely disagree here. First of all, can we fill in that hole? Can China fill in the entire U.S. hole in consumption internally? No, because, I mean, their consumers have different preferences than ours. Now, can they fill it in quickly with just free money? If you give everyone a stimulus check, yeah, they can buy a lot of the stuff we buy.
They're buying a lot of gold, bro.
Yeah, which I mean makes them much more prepared for a hard time than us.
But what I'm saying is that doesn't help. That's not helping out domestic
No,
consumption.
if you give them enough money, and you can think about it, but the central bank digital currency, things like that, you can earmark it. You can be like, speaking of shot clocks, you can be like, you have 90 days to put this money on appliances. Go. You have 90 days to put this money on electronics. Go.
Internally, China can't do that.
Right.
Yeah.
But a lot of make America great again hats are made in China. Are Chinese people going to buy those? No, those just don't get sold, right?
Maybe a couple.
So, but the point being, like, if you get like toys and stuff from Amazon every once in a while, it's all in English. It's clearly geared for American kids. Like maybe it's characters from like Bluey or something, right?
Yeah.
Like obviously Chinese people don't need that crap.
Well, and I'm going to float another idea that I haven't fully vetted. So everybody take this with a grain of salt, but it's something I've really started thinking about over the last 24 hours, which was, I'm starting to begin to think that any solution, quote unquote solution, we come up to this, like a meaningful change. I'm getting to the point where I almost exclusively believe or believe pretty solidly that this is impossible to get done via tariffs alone, because that is ignoring the willing participation of our corporations in this whole thing, right? Meaning, I also think you need to address it with either domestic corporate tax policies or something to either penalize or incentivize these corporations. I was watching a really interesting video, and it's true. It's something that you and I have known. It comes as no surprise to us. But the guy that is going unblamed in this whole scenario right now that deserves a lot of the blame is our U.S. corporations, right?
But at the same time, you can put it on U.S. consumers because U.S. consumers want the most affordable things for the money. I mean,
yeah.
So you could say all that corporation was doing is delivering at the best cost they could.
Yep.
That's why the trade-offs are so steep.
And this is why I was saying
free trade creates a lot of good. And when you unwind free trade, you get the opposite side. You get higher prices, you get less efficiency, you get less productivity, all by definition.
And this is why I was saying I think that it needs to be addressed on the legislative side here in the U.S. regarding, probably a bunch of different kinds of ways. But, like for instance, and is this doing the same thing that China is doing? You made a good point the other day when you pointed that out. It is, but they're not going to stop doing it. So there's a certain point where, okay, look, if these are the rules that they're going to play by, then we've got to play by them too. Right? Meaning to not do that is just to put yourself at an extreme disadvantage. So, but meaning, maybe we need, not maybe, I don't really see any way around realistically onshoring back in the United States without some type of tax incentive.
Yeah.
I don't see how that's possible.
Which some have been floated. There are some already in place. I mean, if you think about the two big, legislative things from the Biden administration, that's really all it is a bunch of tax incentives to manufacture here. That's what is kind of annoying to me is like Democrats don't want to really do tariffs. They just want to do all the incentives and tax rebates and subsidies for, picking the winners. And then all the Republicans want to do is just tariff everything. Don't do any of the other stuff. It's like,
yeah, you need
if you mix those two,
you have to,
you can make a more effective brew. To me, the most important thing is,
well, and Trump's floated that. I mean, look, I know Trump's floated that idea. He's said, he broached the topic of giving U.S. based manufacturers tax breaks.
Sure.
And you're going to have to get a combination of those two. I don't see any way around it.
To me, the important thing is it has to be targeted. This has to be on stuff that matters. It has to be stuff that it matters that we produce, that it has some sort of security alignment, or like, hey, I'm fine with it being a job alignment on some level.
Yep.
But it can't just be like everything. Like,
right.
That's just, kind of 1930s thinking of like, no, we got to make it everything here, or North Korean thinking of pure self-reliance. We don't want to depend on anyone for anything stuff.
Yeah. Well, and a lot of those goods don't even, and the other part of it is they don't put pressure on China. You know what I mean? Like on those types of goods that you're talking about, right? You want to target the things, the high price type goods, the stuff that's got a lot of margin.
Yeah. The high tech things that are going to matter 25 years from now.
Right.
Things like energy and resources, like
chips,
like not being super reliant for those kinds of things totally makes sense to me.
Yep.
And then obviously things that matter in a war, like can you industrially manufacture a bunch of war fighting machines?
It's kind of
because right now the answer is no.
Yeah.
So being able to do that totally makes sense. But do you need to, toys and t-shirts and tariffing, food goods that we can't even grow in America, stuff like that. Like that all has to go away. Yeah.
No, I'm with you. All right, man. Well, we've run out of time. I got to hop to another deal right now, but that does it for us today. What do we got coming up this week? Anything big?
Housing starts and permits.
Okay.
I think that's tomorrow morning. So that'll be worth watching.
Pop and retail sales. That looked to me like front running of tariffs.
Yeah. It was mostly auto sales to front run tariffs.
Yep.
If you look at the control group, it actually missed expectations by a little bit.
Okay.
It's still fine.
Okay.
Nothing alarming. Honestly, no macro data scary at this point.
All righty, guys. Well, you know the drill. Make sure you catch our new stuff. Remember, this is on video. Of course, you're going to want to see us while we're talking. And you get that on YouTube by Googling it's Know Your Risk Podcast. Yes, on Google, Know Your Risk Podcast. I'm still remembering all this.
The website's still radio. Everything else is podcast.
Yeah, you can download and subscribe at Know Your Risk Radio. But if you're on YouTube, TikTok, Instagram, it's Know Your Risk Podcast. That's right. Everything the cool kids are doing. So anyway, have a wonderful evening. We'll see you tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.